All right. Welcome, everyone. Little snafu this morning, but we're back.
We're back.
Oh, we're got a lot of news today, just like the past couple weeks. Main one being Jerome Powell, Sunday, 60 Minutes, reiterated everything, but kind of snuck in there that
he always says something.
Yeah, he kind of just said, commercial real estate might be a little problem. Little one.
These sexy hot takes I know.
He does.
He throws these hot takes in and they come off so minor, snuck in, so monotone.
He just talks like this and it's okay, right?
It's not an issue.
It's not an issue. But
maybe it is.
When you talk like we talk, this is what you get. Commercial real estate, a manageable problem for some banks. Some banks will close. Some small banks will close.
But some banks will. Well, that sounds very manageable. It's manageable for some banks, but not for others. Got you.
Exactly. But hey, we got you covered. You're fine. You're covered.
FDIC.
Yeah. I mean, it's kind of like, New York Community Bank. They had it covered, right? Right?
Absolutely.
I mean, that couldn't be why the risk chief left a month before they reported the Q4 losses.
What is exactly as a risk chief? I would feel like title alone, it's probably the chief officer responsible for mitigating risk.
Yeah, making sure shit doesn't hit the fan.
Okay, so if they, I'm going to assume shit's about to hit the fan.
Yeah, let me look at yeah. Hey, I'm going to go take a vacation for permanent.
Hey guys, nothing to see here.
Hey, early retirement. What the hey? But
hey,
where does this?
Years, I'm good.
Does this sound familiar though? Like we've heard this story before? Like bank before Signature they went Bank? Under?
But who took over Signature Bank's assets?
New York Community Bank?
Wait a minute. Do they know something we don't know?
I think so.
Sitting there and they're like, man, what is a really good roadmap? What's another bank we should follow their lead on?
Yeah, exactly. Yeah.
Let's do the same thing they did.
Their assets. So you know what? We're fine financially. The new CEO came out yesterday, said everything's good, right? We got plenty of assets. Our cap rate's only $3 billion. Wait, no, we're not going to tell you that.
Cap rate's only $3 billion, $113 billion in assets. $3 billion.
Yeah. But our deposits are strong and we're good. What happens when you have a low cap rate and you need to borrow money?
You can't borrow a lot of money.
You can't borrow a lot of money.
Because that's what they're looking at.
Yep. So you're looking at this and you're thinking, I'm watching the hamster go around the wheel the same way it has before.
Yep, exactly. And I think that's something people think about, right? It's why did Signature Bank fall? Why did Silicon Valley? Was because people what ended up happening was people were withdrawing funds, right? But the FDIC insures to $250,000. We don't really care about the FDIC. We're not talking about you and me, right? If you see your bank has lost 60% of its stock value in the last week, you're going to be concerned of, is that bank going to have issues, right? Am I going to be able to have my money, right? But you're protected. FDA. You know who's also going to be really concerned? The businesses that bank with said bank. And they may have more than the insured amount in the bank. So they're going to do what if they're concerned? And they might be pulling out a lot bigger, which would reduce their net deposits, which reduces their liquidity, which reduces and requires them to get financing that's based off their cap rate, which their cap rate is completely shrunk. This is a problem. This is where you see that cycle and that issue happen, right?
Yep. But what's the problem with pulling it out? It's where do you go?
Yeah.
Where do you go? And this is the whole domino effect of what we see happening in commercial, because this is a warning that came out that small banks are headed for trouble amid commercial real estate woes.
Yep.
20 of the largest local banks have over 50% of loans devoted to commercial assets.
And that's something we've talked heavily about on this channel. Every week we're talking about commercial real estate, the potential drop in commercial real estate value. We've seen it, and the domino effects are starting. The first few dominoes have already fallen.
Yep. And this was the interesting line out of this article. Regulators, including Treasury Secretary Janet Yellen, are monitoring the situation closely, urging banks to bolster loan loss reserves and liquidity levels.
If the Treasury Secretary is saying this and regulators are saying this, this is basically them saying, hey guys, we know this is an issue and it's going to be a big issue. And guess what? We're going to be checking on you.
Yep. Bolster those loan loss reserves because we know you're going to have loan losses. We know for a fact you're going to have loan losses and liquidity levels. But what happens to a bank when they have to bolster their reserves and their liquidity levels? What does it now allow them to do now? Provide loans.
Buy loans. Provide loans. Get money out.
Give money out. So now what happens is, okay, that commercial guy who wants to build a strip mall down the road now goes to one of these 20 banks and they say, well, I can't do that loan anymore. Or if I am going to do that loan, I now need this. And instead of doing a 10% down commercial construction perm loan, we're going to have you put in 40%. And he may just say, well, that's not worth it. And I'm just going to walk away. I'm not going to build it. And this is how the whole domino effect begins to just starts to fall.
Yep.
And the whole thing is it's not just here in the US either. Yesterday, German bank PBB, and I'm not trying to pronounce the name, don't make me.
Dutch Pfandbrief Bank.
Is that right?
I have no idea.
Sounded good.
Sounds good.
Sounds good. Which is an extremely large German bank. I think they're second biggest next to Deutsche itself. Okay. They came out and said they were bolstering their loan loss reserves because of their commercial holdings in the United States.
People are just going to love us across the world.
Oh, yeah. Yeah. And listen to this. Despite these expenses, PBB remains profitable thanks to its financial strength, even in the greatest real estate crisis since the financial crisis.
And remember, guys, it feels like a big deal here, but a lot of these, like Germany included, Japan, China, Britain, like so many of these other countries across the world, they're experiencing much worse than what we are right now.
The German housing market itself is in doldrums. They've lost 20 or 30%, somewhere in that ballpark, in their housing values already. And then, of course, you had one of Japan's bank take a 20% hit. Again, due to what? U.S. commercial property. So you've got to look at this and just think, holy cow. You know, we said that it's extremely larger than what happened with the housing market. And you're just looking at like, okay, it's nerve-wracking a little bit. But then you look at it and you think, okay, well, how's all this kind of affecting us? Because you're going to, for the first time in 90 years, the U.S. money supply actually contracted. And the last time this
we have less
happened,
money out there.
we have less money. Why would you have less money? Because you have to cover your loan reserve, so you can't create money by creating loans, which is the way we do it.
Yep.
Correct?
Yeah. First time since 1933. That's coming out of the Depression, right?
That actually was like the middle.
See, they were coming out positive. They were 50% of the way, 51. They were on that
swing, kind of. So you're looking at this, you're kind of looking at this money supply decreasing the first time. What's something we also have talked about, what we haven't really hit on recently, the reverse yield curve between the 10-year and the 2, which has always historically been a sign of a recession.
Yep.
But no one talks about it anymore. It's just like, oh, this is the new norm.
Recession is. It's fluid. Like it's whatever we feel like it is.
Yeah. And with all this going on, you've still got the U.S. yesterday issued a record number of 10-year Treasury bonds.
Yep.
$42 billion worth of Treasury bonds. And they got sucked up.
Yeah.
They got taken like quickly.
It was 87% of direct or indirect bidders by bonds, which was the highest level since August of last year. The cover rate was 2.56, which was higher than the average over the last 12 months of 2. This was an in-demand auction.
It was a good auction. It was actually a good auction. And I think, quite honestly, it's a flight to safety for a lot of people.
Mm-hmm.
Because are you going to be looking at commercial bonds right now?
No.
Not at all. Are you going to be looking to China to buy bonds? No. Nope. Japan? Nope. So where's quote the safest place right now to invest in bonds? It's the US. Actually, they're doing 131 billion today of 30-year notes as well.
I like that. Very conservative. This is sub-inflation percentage. All right, let's see.
But this is the interesting thing. Look what we have to refinance next year.
That's next year. We don't talk about next year.
2024, we have to refinance $8.9 trillion of debt, plus our deficit, which will probably be another 2 to 2.5.
Whoa, didn't you hear though? The Congressional Budget Office this morning was on CNBC. They said our deficit's only at 1.6, not 2.
Oh, I'm sorry. We're improving. Even though they're issuing $760 billion worth of debt this quarter.
We'll look at it.
This quarter. I mean, I think we mentioned that they're kind of front loading so that when it gets to the election, it'll look really nice.
Nice. And I might be jumping around here, but something that was really, really interesting. I'm reading a little notes. The Congressional Budget Office made a comment here that they anticipate unemployment to rise to 4.4% by the end of 2024. We're at 3.7% right now. That's not that big of an increase.
What is that? That's a million
people in unemployment.
You know what that tells me, too? You know when the first rate cut's going to be? June. You know why? Because historically, after the first rate cut, after a rate increase, unemployment jumps 6 months after. You can go back and check the charts. Unemployment always jumps 6 months after the first rate cut.
Really?
Which I found that one interesting. It's like, but you go back and you check, like, oh my gosh, it is. It's actually right. Roughly 6 months, all of a sudden the unemployment rate will speed up.
It's reading straight off of their conversation. Like you have their transcript because they said that they expect the Fed to start cutting in either the May or June meeting of this year. But this is the Congressional Budget Office.
It's not like history ever repeats itself.
No, it could be wrong. They're going to cut in March.
Yeah.
Yeah. We all know that's not happening.
Yep, that is not happening. But how is all this affecting
all those realtors 3 months ago that wasn't going to happen? I was getting hate mail.
Oh yeah, I was getting okay. You believe what you want to believe. No.
What's actually happening?
Yeah, I'll look at the charts and data. But how's it affecting our industry? Well, we lost a wholesaler today. I don't know if you ever used.
I didn't work with Fairway on their wholesale. They still have a retail division. But basically, Fairway operated two divisions, a retail, like a direct consumer, and then a wholesale, which is where they work with brokers like myself and so forth. And they shut down their wholesale division to focus all their efforts on the retail, which tells me, like, why would you shut down a division?
No business.
Concern, like, can't have the money and resources in that. Like, you've got to consolidate. You're not profitable. Like, you don't shut down things that are working, right?
I think based on the volume of sales and the lack of refinances, I think you may see your pool shrink up a little bit like we have in the past. What happens before a recession? You start seeing some of these lenders start closing their doors.
Over the last year.
And then this is a company that we do a lot of work with here in real estate. All the electronic signatures, probably 90% of the electronic signatures that go out,
80 to 90.
Yeah, are with DocuSign.
Yeah.
And they just cut their workforce by 6%.
I just like the CEO. Sorry that we have to do this again. Hey guys, I'm super sorry that we got to do this again. Hey, 400 of you, you're gone.
You're gone.
What will be really interesting is I'd like to revisit this article at the end of the year, like Q4 or Q1 of next year when they're doing their fourth, like their annual or their Q4 reports. I'm curious what bonuses the CEO is going to get for how he managed them through this, this hard time.
Yeah, those are always the interesting ones. So you see, all this economic news is affecting us. I think what we're trying to show you is that we're trying to get beyond just the headline of the way you make things look. 8% up. This this is great. But it's always where you got to look into the details of the whole thing. Mm-hmm. And then for our market, what we're seeing here in Orlando is, you've seen the slower pace of everything overall. And, getting into this week's numbers, we did have a little bit of an increase in the number of sales. We jumped from 259 to 356. That's nice. That's roughly about 100 homes, additional homes sold. But what I did is I went back and looked at, what was the rate about 30, 45 days ago? That's our typical closing time period, right in there. And that was really where we had hit that low again. The T-bill had dropped to about 3.8, and we're sitting at that 6.5 rate. And it felt like, hey, things were going to pick up a little bit overall. And you can see they did. More homes actually sold.
Yep.
Inventory holding pretty steady overall. But then our condo market is still just in the doldrums with only 116 homes sold for the week. And the inventory continues to increase. And the one thing that didn't change during this time, even though we sold more homes, is the amount that people are coming off their original list price. Mm-hmm. We are holding steady at roughly about 93.5% off the original list price on average. And in the high-end luxury market, you're seeing a big difference. They're about 10% off the original list price. So on $1.5 million home, you should be able to negotiate roughly about $150,000 off that original list price. That's a big cut.
Yeah.
That's a really big cut. And then we look at our sales overall. You see the weekly sales. We finally got back above that median line. The period average is 323 right now. Finally pushed back above that. And then days on market, we're still holding steady in that 60-day range. And you can see the inventory over the past month really kind of flattened out a little bit. I'm expecting, usually mid-March is when we start seeing people getting ready for the spring season. See that pop up a little bit. Then we get into the condo market. This is where you're seeing the real huge price drops. And this one was the big one, under $250,000, which I think probably is about 75% of the condo market here. Mm-hmm. Really? Look at this, 84.5% off the original list price.
That's a big drop.
That's a huge drop. And the days on market is just holding steady up there. It's 64 days on market. And then again, we look at our weekly sales, and our average has dropped to 109.
But we at least peaked over it this last week.
Yeah, end of the month. Let's see what it does next week.
Absolutely.
And then our inventory is continuing to increase. Just since January, we're up nearly 7% on the inventory. And a lot of this, I think, is a lot of investors saying, I can't afford to hold these properties and rent them anymore due to the, if they've got a loan, the carrying cost of the loan and the carrying cost of the HOAs. And this, I wanted to throw this one in because I found it interesting. In the condo market, active foreclosures, we jumped to 11 active foreclosures where we've held, pretty steady around 4 or 5. Over the past couple of weeks, the active foreclosures on condos is picking up.
It's only 11.
I know it's not nowhere near where it used to be, but when you double the number of foreclosures, is that a tall tale sign for what may be coming down the road?
Maybe, and it's all because what we've talked about the condo market in Florida specifically, like with the insurance requirements, the updates, and it's really just, I get it. Like costs are going up, and these associations, they don't want to increase their monthly condo dues. And the challenge is sometimes they're making decisions not understanding that decisions to save $10, $15, $20 a month because they just don't want to see another increase and say, well, we're going to increase our deductible to X from this to that as an association to keep our costs down. And now that's not insurable for Fannie Mae, Freddie Mac. And now they basically have properties that they can only get cash buyers, and they're stuck because you've shrunk your pool. Yep. And that's the hard part is they just don't know. And you have property managers that don't understand or aren't conveying these to the association boards or to the actual owners when they're having these votes and making these decisions. And they're basically, and the big key here is like we've talked. You talk to once they make the decision. Now we have to, if we want to change a lot of these boards, they have to hold a meeting. They've got to give ample notice. God, yeah. They've got to get 70% approval or 60% approval in the community, which that might take 45, 60 days for them to go through the notices, the scheduling, everything else, just to have the meeting to decide if they're going to do this. So we don't even know. Like people trying to sell from those communities are stuck sometimes, and they don't realize it.
Yep.
Until it's too late.
And I just don't see that market recovering quickly. I think it's going to be a very stale market, actually, for a couple of years. Yeah, until something's got to even out on it.
Yeah, I know that there's been some insurance reform in Florida on the state legislative level that we were told that happened last year. We were told it's going to take about 5 to 6 years for it to balance out. So I could say, like, if it's going to take 5 to 6 years to balance out, we could be looking at that entire tenure or duration being a soft point or a stale point for condos.
Yep. Very true. Very true. Well, thank you all for joining us again. Joe, thank you as always. We'll see you next week. Take care. Bye-bye.
Rocky, guys. Like, subscribe, hit that, do something, share it.